Trading with the trend is hands down one of the most effective ways to make consistent profits in any market. In today's video, I'm going to walk you through a really solid indicator that helps cut out most of the fake signals you normally see when trading. If you find this video helpful, don't forget to hit that like button. Alright, let's dive right in. The indicator we're covering today is called the regularized moving average oscillator. To get it on your chart, head over to TradingView like always and pull up any asset you want to trade. For the time frame, you can use anything between the 5-minute chart and the 4-hour chart. Personally, I prefer the 15-minute. Once you're set, go to indicator search bar, type in a regularized moving average oscillator, and choose the one created by this amazing author. Big shout out to them, by the way. The regularized moving average oscillator is a complete trading tool that provides strong insights into overall market direction and momentum. It calculates moving averages based on the settings you choose, which include things like the length of the moving average, the type of average, and even any smoothing adjustments you want. Now let's break down its main features. The horizontal line in the middle is the zero line. That's the core reference point for this indicator. Then you've got the upper and lower boundaries, which represent the overbought and oversold zones. Finally, there's this line that switches colors between green and red. That's known as the Z line. It's written right on the chart. If you toggle it on and off, you'll see exactly which line it is. When the Z-line moves up into the red zone, that suggests the market could be overbought. On the other hand, when it dips into the lower green zone, that's a sign the market might be oversold. You'll also notice little green and red dots inside those zones. These are called reversal bubbles. The green bubble at the bottom signals a potential bullish reversal, while the red bubble up top signals a possible bearish reversal. As the name suggests, these are meant to highlight points where trend might flip after the market enters an extreme area. There are a couple of different ways you can use this indicator in your trading. The first approach is to treat it as a trend-following strategy. That means you'd enter a buy trade whenever the Z-line crosses above the zero line and turns green, just like it did here. For sell trade, you'd wait for the Z-line to fall under the zero line and switch to red. Of course, this by itself is a very basic strategy. You'd still want to combine it with other tools and some price action analysis to make it truly profitable. But let's move on to the second approach you can use with this indicator. The second way to trade this indicator is by using it for a mean reversion strategy. Mean reversion basically means that price has a natural tendency to snap back towards its average. So, when the market stretches too high, it often comes back down, and when it drops too low, it usually rebounds upward. In practice, this means you're looking to buy when the market is oversold and sell when it's overbought. For instance, here you can see the market was oversold, shown by the green reversal bubble. So we'd look for a buy. Then, over here, the market was overbought with a red bubble showing, which sets up a short trade. Let's now adjust the settings of this indicator to make it fit the strategy we're highlighting. Open up the Inputs tab and change the length to 10 and the regularized length to 20. Hit OK. Next, open the Indicators tab and add one more tool. Search for Super Trend and pick the one by Everget. Big shout out to them, by the way. Double-click to bring up the settings. Change the ATR period to 30 and the ATR multiplier to 5. Then, under the Style tab, turn off both the buy and sell labels and hit OK. So now our setup uses these two indicators, but we're also going to add a price action confirmation. Basically, we want to see either a clean break and retest of support or resistance, or a strong bounce off one of those levels. Let me show you exactly how it works. For a long entry, we need three things. First, the market has to be in an uptrend. We confirm that using the super trend indicator. It should be green, and price should be trading above it. Second, we want to see a pullback within that uptrend. The way we confirm that is when the Z line switches from green to red, then back to green again. That change shows a retracement. Third, the pullback has to last at least 5 candles, but no more than 10. So from this point to this point, we need the candles inside that red zone to number between 5 and 10. In this trade example, we had 7 candles, so it's valid. The entry candle is the first one that corresponds to the Z line turning green again. That's this candle right here. But we also want to add price action confluence. So once we've got our entry candle, we check the chart structure. We're looking for a clear resistance level that price broke through and retested just before the entry. If there isn't a resistance level nearby, then we'd look for price to bounce off a strong support level instead. In this example, there was a strong resistance here. Price broke it, we tested it, and then lined up with our entry candle. That gives us higher probability for the trade. So we enter long, put our stop loss just below that resistance, and set our take profit at twice the risk. We let the trade play out, and it hit TP. Here's another buy example. But this time, instead of a break and retest of resistance, price bounced off a strong support. The indicator signals were the same. The market was in an uptrend with super trend in green, then pullback happened as the Z line flipped red and back to green. There was 8 candles in the red zone, which falls right in the 5 to 10 range. Plus, price rejected that support level right before the pullback ended. That gave us the confluence we needed. Again, stop loss went just under support, take profit was set at 2 times the risk, and the trade hit target. Now let's look at a short example. Here, the market was trending downward, shown by super trend in red. Then we saw a pullback within the downtrend, confirmed by the Z line flipping from red to green and back to red. This pullback lasted exactly 10 candles, which is still within our 5 to 10 window. Our entry candle was the first red candle after the pullback, right here. Looking at price action, there was a clear resistance zone. Price retested it and rejected it just before our entry candle. That gave us all the confirmation we needed. We entered short, set our stop loss just above the resistance, and targeted 2 times risk for the take profit. Trade ran, and it hit TP. So, to wrap it up, the regularized moving average oscillator is a really powerful tool that helps spot market direction and possible reversal points by breaking down price behavior in detail. When you combine it with other technical indicators plus solid price action techniques, you can seriously improve your decision making, boost accuracy, and optimize your entries and exits. If this indicator caught your attention, check it out on TradingView and test out your own settings and strategies. And if you're looking for different approaches to turn any trading strategy into a bot with alerts so it does the job for you 24/7 while you're not around, make sure to check the recommended playlist on your screen. That's all for today's video. I hope you found this helpful. If you did, make sure to hit that like button and consider subscribing so you don't miss what's coming next. Thanks for watching, and I'll see you in the next one.